Welcome to Think and Grow Exponentially. My name is Mark. Many people are interested in investing their money but don't know where to invest. Should I do savings, certificate of deposits, bonds, stocks, real estate, gold, or some other form of investment? In this video, I will discuss the different types of investments, their risk and returns, and why it's important to invest. Before we talk about investments, let's take a look at the cost of living for three different time periods: 1943, 1971, and 1999, each 28 years apart from one another. Look at some of those crazy prices in 1943. A new house for only $3,600, a new car for $900, a dozen eggs cost less than a quarter. 28 years later, a new house increased to $25,200, a new car to $3,560, and a dozen eggs for less than two quarters. And in 1999, a new house costs $131,710, a new car is $21,022, and a dozen eggs for less than $1. I'm sure the prices for each of these items today is much, much more. So why are prices going up? Prices go up because of inflation. Inflation is when your money loses value over time, causing prices to rise. This means the dollar that you have today will be worth less next year. For example, $1 in 1943 could buy you 10 loaves of fresh baked bread. Because of inflation, however, the dollar lost value over time and in 1999 could not even buy you one loaf of fresh baked bread. So you see those dollars that you have in your home? It's slowly losing value over time as it sits there, doing nothing. That's why we need to invest to make sure it's worth more in the future instead of less. Before we learn more about the different types of investments, we have to understand the risk-reward trade-off. The risk-reward trade-off suggests that the more risk you take, the more potential reward you may earn. As a result, cash investments have the least risk and reward, while stocks have the most risk and reward compared to cash and bonds. There are also many other types of investments. They can be seen here in this investment risk pyramid and include real estate, cryptocurrencies, and precious metals and gems. In this video, I will be focusing mainly on savings accounts, certificate of deposits, known as CDs, bonds, and stocks because they are commonly used and easy to follow. To learn more about what exactly a savings account, CD, bond, or stock is and how they work, please check the YouTube description below for video links. Here are two charts following a certain type of savings account called a money market account. If you follow the red line on the first graph and the green line on the second graph, you will notice that interest rates are declining for money market accounts. In 1987, a 5% interest rate would make a $100 investment worth $105 by the end of the year. Today, the interest rate is about half of 1%. That means a $100 investment would end up being $100.50. As you can see, the interest rate never goes below 0%, so there is no risk on a savings account. You will never lose money. There's also almost no reward too, since interest rates are near zero today. Now let's take a look at CDs. Once again, interest rates are declining over time from 12% to near 0%. However, a CD has a better interest rate than a savings account because there's slightly more risk. The money cannot be touched for 6 months, a year, or 5 years without penalty. These next two graphs show riskier investments, bonds and stocks. When the bars are above 0%, we have a positive return, and when the bars are below 0%, we have negative returns. In the past 100 years, bonds achieved positive returns about 80% of the time, while stocks achieved positive returns about 70% of the time. Bonds also have more stable results. The returns range from negative 15% to positive 40%, whereas the returns on stocks range from negative 47% to almost positive 60%. So looking at history, it would seem that bonds are better than stocks because they are safer, produce more positive yearly returns and less negative ones, right? Wrong. If you invested $1 in stocks and $1 in bonds starting in 1927, 90 years later, that $1 in stocks would be worth $3,828.70, while the $1 in bonds will be worth only $73.08. How is such a huge difference possible? Here are all the annual returns for the S&P 500 from 1825 all the way to 2019. In the past 195 years, 138 of those years produced positive returns and 57 produced negative returns. That is a 70% success rate. Furthermore, look at the chance of gaining or losing a certain return. We're 10 times more likely to gain positive 40% returns than lose it, 8 times more likely to gain 30 to 40%, 4 times more likely to gain 20 to 30%, 2 times more likely to gain 10 to 20% returns, and 1.5 times more likely to gain 0 to 10% returns. The odds are definitely stacked towards making money in stocks. Here are the annualized returns for 5 different types of investments: cash, treasury bonds, S&P 500, real estate, and gold. Based on the heat map, red represents the worst investment among the 5 for that decade, and blue represents the best investment for that decade. The heat map also matches the risk-reward trade-off discussed earlier. Gold can be the best investment in some decades, yet the absolute worst in other decades. But what if I'm trying to retire? Looking at 10 years of returns is not enough. So let's take a look at 40 years of annualized investment returns. This assumes you begin working in your 20s and retire in your 60s. I decided to graph the best 40-year period for cash, bonds, real estate, and gold, along with the worst 40-year period for stocks, to see how they would compare. Even in the worst 40-year period for stocks, it still beats the other 4 investments. A $10,000 investment in 1930, which is during the Great Depression, would be worth $298,354.92 by 1969. The worst 40-year period for stocks is better than the best 40-year periods for gold, real estate, bonds, and cash. Now, what if we included the best 40-year period for stocks? Stocks absolutely crushed the other 4 investments. A $10,000 investment in 1950 would be worth $1,135,960.88 by 1989. To wrap things up, here's a summary of everything discussed in the video. Make sure to invest your money, otherwise your money is worth less over time, as seen in the cost of living examples. Investments have different levels of risk and reward. The more risk you take, the more reward you get. Make sure to understand the risks and rewards for each type of investment before committing. If you hope to get the best returns, invest for the long run. History has proven that stocks are the best long-term investment. If you like what you saw today, please don't forget to like and subscribe below, and tell your family and friends about this channel. Thanks for watching, and remember, think and grow exponentially. Take care. I need to start investing in that money chart. It's losing value over time.